Chapter 13, Corporations. The corporation is one of the most familiar forms of business organization. Unlike a sole proprietorship or a partnership, the corporation holds the status of a separate legal entity capable of owning property, entering into contracts, and paying taxes. There are several advantages of the corporate form of business over other business forms. Owners, or shareholders of a corporation, are shielded from liability for the actions of the corporation. In addition, there is no real limit to the number of owners that a corporation may have. Finally, a corporation has its own indefinite life. Even when the owners pass away, the corporation continues to exist. There are also, however, some disadvantages to the corporate form of business. Because ownership and management are separated, the issue of agency and incentives becomes important. Essentially, management is expected to act in the best interest of the stockholders. However, in many cases, management acts in their own best interests, to the detriment of the stockholders. Also, income from a corporation is double taxed. Essentially, income is taxed at the corporate level. Then, when the already taxed income is distributed to owners as dividends, the income is taxed again at the personal level of the stockholders receiving the dividend. Other disadvantages include government regulation and oversight, as well as generally higher startup costs compared to other forms of business. Ownership in a corporation is represented by stock certificates. A stock certificate, usually very ornate in design to discourage counterfeiting, will include information such as the name of the stockholder, the company name, the number of shares represented by this particular certificate, and the date that those shares were issued. Stock certificates may also be serially numbered and are registered. Authorized shares represent the maximum number of shares of stock that a company can issue. Generally, this information is contained in the company's charter. Issued shares are the total number of a company's shares that have been sold over time, so sold from the company to shareholders. Outstanding shares are the number of shares of a corporation's stocks that are currently in the hands of investors. Treasury shares are issued shares of stock that have been previously issued out to stockholders, but later reacquired by the corporation and are being held by the corporation. Stockholders have certain rights of ownership. The most important right is the right to vote at the annual stockholders meeting. In almost all cases, one share equals one vote. So the more shares you own, the more votes you get. Issues voted on include members nominated for positions on the board of directors and certain policy issues, such as the approval of the audit firm or mergers with other companies. Stockholders have the right to receive a proportional share of any dividends declared by the company and to share proportionately in a distribution of available cash proceeds in the event that the company is liquidated. Finally, stockholders have a preemptive ownership right. This entitles stockholders to purchase additional shares of stock when the company issues new shares, in amounts sufficient to maintain their percentage of ownership. On occasion, when a company desires to purchase another company using a new issuance of stock, stockholders will be asked to suspend their preemptive stock ownership rights in the best interest of the company's growth overall. Preferred is a special class of stock with unique characteristics. Primarily, preferred stockholders receive preference in the distribution of dividends. Because of the unique structure of preferred stock, the amount of dividends that a preferred stockholder will receive when dividends are declared is predetermined by the preferred stock contract. For example, a 5% preferred stock will receive 5% of the par value of that stock when a dividend is declared. When the board of directors declares a dividend, the amount that will go to the preferred stockholders is taken out first, before determining how much each common shareholder will receive. In addition to a preference with respect to dividends, preferred stock usually have no voting rights. This is a try it. So basically you're going to look at this question and try to answer it. You can take a look at it, pause the computer, figure out what your answers will be, and then I will give a little bit of time in between revealing the answers for each question, just so if you're pausing and following along and trying to answer yourself, you'll be able to do that. When common stock is issued, the company will receive cash from the new investors. In addition, the claims against the assets will increase, so the equity accounts of common stock and paid-in capital in excess of par are increased to reflect the investment of the new stockholders. The entry will include a debit to cash. In addition, there will be a credit to common stock for the number of shares issued times the par value per share for par value stock. The remainder of the receipt from the stock issuance are credited to paid-in capital in excess of par. This is, of course, assuming that the stock is selling for greater than what the par value on the stock is listed as. Smart Touch Learning sells 1 million shares of its $1 par value common stock for $1 per share. Prepare the entry to record this issuance of common stock. Well, this is what the entry will look like. We'll include a debit to cash for $1 million and a credit to common stock for $1 million. Since it was at par value exactly, there is no paid-in capital in excess of par affected here. Let's look at this example. Smart Touch Learning sells 1 million of its $1 par value common stock for $20 per share. Prepare the journal entry to record the issuance of common stock. Well, you're going to first debit cash for the amount of cash that you receive, which will be the value that you're selling it at, $20 per share times the shares, so that will be $20 million. It's still $1 per share par value, so you will credit common stock for $1 million, and then the difference between that $20 million and the $1 million will be credit to paid-in capital in excess of par for common stock. On the balance sheet, the issuance will be reflected in the equity section. Common stock and paid-in capital in excess of par are considered to both be capital accounts. Retained earnings is the other account that makes up the equity section at this point. Notice that for common stock, there are several pieces of information that accompany the account title: par value per share, number of shares authorized, and number of shares issued and outstanding. This information is required by GAAP to be disclosed on the balance sheet. Issuing preferred stocks follow a similar process to the issuance of common stock. Smart Touch Learning issues 1,000 shares of its $50 par value 6% preferred stock on January 3rd for $55 per share. How do you record that? Well, again, you're going to multiply the dollar value per share that you sold it at times the number of shares, debit that amount to cash. You're going to look at the par value, not what you sold it at, and multiply that times the number of shares, and that will be your credit to preferred stock, and the difference between the two will be your credit to paid-in capital in excess of par preferred. On the balance sheet, preferred stock is recorded in the equity section, usually right before common stock. Dividends are not required for any corporation. They are only paid after the board of directors declares that a dividend will be paid to the stockholders. The board of directors decides the total amount of the dividend to be distributed, or in some cases may decide how much dividend to pay per common share. In either case, when the dividends are declared, they become a legal liability for the company and must be recorded as a liability at that point. There are 3 critical dates associated with the declaration and payments of dividends: the declaration date, On this date, the Board of Directors votes to pay a dividend. This action creates a dividend liability that must be recorded. Record date. No transactions related to the dividend need to be recorded at this point. However, only investors who actually own stock on the record date will be entitled to receive the related dividend. So it's basically a threshold date. If you own stock before this day, you get the dividend. After this day, you do not. Payment date. On this date, which can be anywhere from a couple of weeks or a month past the declaration date, dividend checks are mailed to the stockholders of record on the record date. The dividend payable is satisfied and a cash payment is recorded. On the declaration date, the company will make a debit to retained earnings and a credit to dividends payable for the amount of the dividend. On the record date, as was stated before, there are no journal entries that need to be recorded. Then on the payment date, the company will record a debit to dividends payable and a credit to cash to indicate that the dividends have been paid. On May 1st, SmartTouch Learning's Board of Directors declares a 25-cent per common share dividend on the 2 million outstanding shares of common stock. Record the journal entry for the declaration of the dividend. So again, we're looking at what happens on the declaration date. So on the declaration date, we figure out the total amount that the dividend is going to be, which is 2 million times 25 cents. That gives us $500,000, which we debit to retained earnings to show that our retained earnings go down. And then we credit this to the liability account, dividends payable common, to show that we recorded a liability. On May 30th, SmartTouch Learning pays the dividend to its stockholders. Prepare the journal entry. Again, this is the payment date. So the entry will require a debit to dividends payable because we want to eliminate that liability that we have from dividends payable, and then we'll credit cash because we're actually paying out cash to shareholders in the amount of $500,000. Preferred stockholders also receive a portion of the dividends declared by the Board of Directors. Because of their preferred status, the preferred stockholders will receive their dividends first from the total dividends declared by the Board of Directors, with the remainder being distributed to the common stockholders. On the preferred stock certificate or contract, the amount of the dividends for the preferred shares will be indicated as a percentage of the par value. Although this is not a guarantee that a dividend will be paid, it does define how much the dividend will be if there is a dividend declared by the Board of Directors. For example, if a preferred stock has a $100 par value and is designated as having 6% dividends, then the shareholder will receive $6 per share in dividends if a dividend is declared by the Board of Directors. The preferred dividend can be designated as cumulative or non-cumulative. If the dividend is non-cumulative, then any undeclared dividend is lost forever. If the dividend is cumulative, then any undeclared dividend for the current year will be designated as a dividend in arrears and will carry forward to be paid out of future dividends should they be declared. So as you can imagine, if it's cumulative, it will keep building year by year, even though it's not actually paid and doesn't create a liability until dividends are declared. What that basically does is give preferred shareholders a much greater portion of dividends in future years because you are basically adding up all the years they should have been paid dividends, and it makes it less likely that common shareholders will get anything from future dividends until those dividends in arrears are paid out to the preferred shareholders. SmartTouch Learning issued 1,000 shares of $50 par value 6% preferred stock on January 3rd. There were no dividends declared or paid in 2015. In 2016, the Board of Directors declared a $50,000 dividend to be split between the preferred stockholders and the common stockholders. The investors holding the 1,000 shares of preferred stock are entitled to be paid first. In addition, the first amount they will receive is the dividends in arrears for 2015. Then they will be paid the dividends for 2016. The dividends in arrears amounts to $3,000, or $1,000 times $50 par value times 6%. The dividends for 2016 will also be $3,000 using the same calculation. So the first $6,000 will go to preferred shareholders, leaving $44,000 to be paid to common shareholders. Record the declaration of dividends for 2016. So, in this particular instance, we have a $50,000 dividend. We have $3,000 for this year, $3,000 in arrears to preferred shareholders, and then we have the $44,000 to common stockholders. So the entire $50,000 will be debited to retained earnings to show that we no longer have those earnings. And then we will create liabilities in dividends payable to common shareholders and dividends payable to preferred shareholders. Sometimes a company will decide to forego a cash dividend in favor of a stock dividend. Issuing a stock dividend allows the company to issue something of value to the stockholders without having to pay out any cash. A stock dividend will not change the total stockholders' equity for the company. There will be no changes in par value, and all stockholders will retain their percentage of ownership. Stock dividends can be divided into two different types, each with some distinctive accounting features. Small stock dividends represent an issuance of new stock that is less than 20 to 25% of the total outstanding common shares. The 20 to 25% range allows for some discretion in making this determination. Accounting for a small stock dividend will require a debit to retained earnings for the market value of the additional shares issued and a credit to common stock for the par value of the shares issued. The difference between the two will be a credit to paid-in capital in excess of par. For large stock dividends, this would be a stock dividend of new stock that represents an excess of 20 to 25% of the total outstanding common shares. Accounting for a large stock dividend requires a debit to retained earnings for the par value of the shares issued and a credit to common stock for the par value of the shares issued. So you basically don't care for a large stock dividend what the market value of the stock is. You're only using the par value, and you're not obviously worried about excess capital or paid-in capital in excess of par. Now, when an issuance of new stock is greater than 100% of the currently outstanding common shares, then the distribution of stock is called a stock split. When a stock split occurs, the accounting will show an increase in the number of outstanding shares and a corresponding decrease in the par value of the outstanding shares that is proportionate and sufficient to ensure that the common stock account does not change value. For example, suppose that Smart Touch Learning has 3,150,000 shares of $1 par value common stock outstanding. If they issued a 2-for-1 stock split, the number of shares outstanding will double. The number will be 6,300,000. In addition, the par value of those shares will be decreased from $1 to 50 cents each. So the overall par value of outstanding shares will remain the same. Often a stock split will also result in a corresponding proportionate decrease in the market value of the shares. Companies will sometimes reacquire their own shares from the market. When the company reacquires shares, the law of supply and demand will inevitably support a higher market value for the remaining outstanding shares. The reacquired shares will be stored for later redistribution to employees, officers, as stock dividends, or perhaps as currency in some type of acquisition. While the company's shares are held as treasury stock, the shares have no voting or dividend rights. Treasury stock will be recorded at cost and will be reported as a contra equity account in the equity section of the balance sheet. On May 31st, Smart Touch Learning purchased 1,000 shares of previously issued common stock, paying $5 per share. record the acquisition of treasury stock. The entry will require a debit to treasury stock for $5,000 or 1,000 shares times $5 per share cost, and a credit to cash for $5,000. As shown in Exhibit 1310, treasury stock is reported in the equity section as a contra equity account. So you see it right here. And by contra equity, basically what that does is serves to reduce the overall amount of equity that we're showing here. The statement of retained earnings only shows us the changes in the retained earnings account from the beginning of the period to the end of the period. In addition to net income, net losses, and dividends, there is an additional potential accounting item that can impact retained earnings. This would be a prior period adjustment. When a company discovers errors in previous statements, rather than correct the previous statements for the error, a company will show the cumulative effect of the error as an adjustment to retained earnings referred to as a prior period adjustment. Publicly traded companies will likely use a statement of stockholders' equity instead of a statement of retained earnings. The statement of stockholders' equity will show the changes in all the accounts that make up the equity section of the balance sheet. Here's another try-it question that you can take a look at. Remember to go ahead and pause it if you are reading through it and would like to try to answer it on your own before you see the answer displayed on your screen. And here's what that answer would look like. Earnings per share is computed as net income minus preferred dividends, in parentheses, divided by average number of common shares outstanding. This amount is computed only for common stock and is reported on the income statement. Examine the information for Green Mountain Coffee Roasters. Compute earnings per share for 2011. Net income for 2011 for Green Mountain Coffee Roasters is $199,501,000. Preferred dividends are 0. The average number of common shares outstanding is 143,645,024, computed as the ending 2010 common shares outstanding plus the ending 2011 common shares outstanding divided by 2. In this case, you have 132,823,585 plus 154,466,463 divided by 2, and that gives us 143,645,024. So the 2011 earnings per share is 199,501,000 divided by 143,645,024, or $1.39 per share. The price-earnings ratio is a ratio of the market price of each share of common stock to the company's earnings per share. Price-earnings ratio equals market price per share divided by earnings per share. Assume that the market price for Green Mountain Coffee Roasters has a market price of $17.90 per share at the end of 2011. Compute the price-earnings ratio for 2011. Well, you see the equation right there, so all you have to do is plug that in, and you get a PE ratio of 12.88. The rate of return on common stock is also referred to as the return on equity. It is computed as displayed right here. Now, using the information for Green Mountain Coffee Roasters, compute the return on equity for 2011. So again, we're just plugging in numbers here and doing the equation. And when we do that, we get a return on equity of 15%. So here's another opportunity to try it out for yourself. And here's another one. And another. And that's the end of the chapter.